Hi guys, welcome back. Today we're going to be looking at Tesla. Recently, this company has reported its first quarter results for 2021, and they beat both their top and bottom line, which showed healthy growth compared to the previous year. So today we're going to be looking at whether Tesla is now a buy. If you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So what are the positives that came out of the earnings report? So Tesla recently announced that it grew its deliveries massively year over year, which caused its revenue to increase more than 70% year over year, which is a lot even for a growth stock like Tesla. They also beat revenue estimates despite already having announced delivery numbers for the quarter, which shows that the company was able to outperform analyst estimates when it came to their sale prices as well. Tesla in the past was criticized for its lack of durable cash flow, and many bearish analysts have talked about the company's inability to finance their capital expenditures and would put the company heavily in debt. But this has recently changed, and in quarter one, Tesla again showed that it was able to generate all the cash that the company needs to finance its capital futures. And Tesla's operating cash flow shows that there was $300 million higher in its capital expenditures, resulting in a small positive free cash flow for the quarter. We can look at how Tesla's balance sheet was also doing. They have more than $17 billion in cash and other liquid sources. So Tesla has enough liquidity to finance its near-term cash needs, such as the new factories that it's building in Texas and Berlin. So what are the not so good things that came out of the Tesla earnings report? So if we look at their income statement, we can see that despite having good business growth, they still haven't been able to become profitable purely through auto sales itself. So during the first quarter, they had regulatory credit sales, which topped more than $520 million, which outpaced their net income by $80 million. So without these credit sales, the company would not have been able to turn a profit. So credit sales are payments that are not made until several days, weeks, or after a product has been delivered. However, they can still count in a firm's balance sheet, and which shows the short-term increase of the company's profitability. But without the credit sales, we can see that profitability of Tesla in quarter one would be weak. The problem with credit sales is that it's not an everlasting source of revenue. If EVs continue to make big gains in the automobile market the way they have currently, more and more regulatory credit sales will be sold, and that will mean that less and less auto companies will need them. Eventually, this would cause a market dry up, and then this part of Tesla's business will not be profitable in the long run. Another thing is that Tesla is primarily a car company with more than 90% of its revenue generated through that source. However, they still have outsourcing other kind of side ventures, such as being an energy company or a tech company. The non-auto ventures have contributed more than $1.4 billion in revenue during this quarter. This was up from $0.9 billion during the previous quarter, but flat if you don't take that into account. But however, although this has been growing, they had a gross profit of more than $80 million compared to the previous quarter last year, and then more than $170 million during the first quarter of 2021. So in other words, even though their side ventures were growing, they still lost more money than they were, and that is dragging down Tesla's overall profitability. The next thing we're going to be looking at is the valuation of Tesla. So Tesla is currently valued at $700 billion, despite being only marginally profitable and not even profitable if you don't factor in credit sales. The company sells about 800,000 vehicles annually, which is their projected for 2021, and it's valued exponentially more than many registered strong car companies like Toyota, Volkswagen, Nissan, etc., which sell more than 10 million vehicles each year and are more profitable than Tesla at the same time. If you compare Tesla and Toyota, we can see that Toyota is 20 times cheaper than what Tesla is valued, even when the revenue is taken into consideration. Even after massive growth is priced into Tesla shares, there is no guarantee that Tesla will become the profitable car company that people say they were, and they were able to take market share from the current car companies. On top of this, there have been more EV startups in the last year than ever before, and even mega corporations such as Apple are entering the industry. So we could see Tesla's growth slow down in the coming years, and when you're talking about the weak profitability, especially with credit sales, will eventually decline. The company's valuations of $700 billion is not worth it. This is not saying that the company cannot grow in the future, but purely saying the current valuation is too much, even if you factor in future growth. The last thing we're going to be looking at today is the technical analysis. We can see the Tesla stock price increased a lot from about $180 all the way to $900 a few months ago at the beginning of 2021. And after the small market correction, the stock price is currently trading at about $704. However, we can see here that between the last 4 months, the stock price is trading at a significant discount, more than $200, and is trading close to its 50-day simple moving average, which is a good sign. So if you do choose to invest, even though the valuation fundamentally is very expensive, if you look at the stock price here, it is trading at a cheap valuation, especially if you focus specifically on the last few months. And with that, Tesla being a growth stock, trading at its 50-day simple moving average is not too bad of a place to pick it up if you believe it'll grow into the future. So just some final words. They had some certain positives such as earnings beat and increased profitability, but they still rely heavily on credits for revenue as well. Overall, it is very highly overvalued fundamentally, but the stock is trading at a decent valuation if you look at it over the past 3 or 4 months. So if you do choose to invest, make sure to do your own due diligence, and thanks for watching. Bye.